What's going on, guys? This is Frank Chen with REIClub.com, and welcome to our podcast where we get face-to-face with real estate experts from all around the nation, where we ask questions that you need the answers to. Today, we have a great call for you. Right there, you got to see two handsome gentlemen, and hopefully I don't mess up their names. We have Eric Sangerhausen with us and his business partner, Mike Arch, based out of San Antonio, Texas. So these are our fellow Texans, so it's really great to have them here. Go ahead and say hi, guys.
Hey, how you going?
All right, right on. So what we're going to be talking about today, before we get into the nuts and bolts, is seller financing and really how that can benefit you as an investor. We're going to figure out, what types of properties you're going to be looking at, really the idea behind the strategy and really how to build cash flow with this. So if you're on this call today and you've been wondering, how do I build cash flow with real estate if I have little to no money? This is one of those strategies we're going to be talking about. So you're definitely on the right call. I'm really excited to start doing this. So we're going to get right into this. How are you guys doing, by the way? How's San Antonio? How's the weather? I know here in Austin, it's so hot, man. It is so hot.
It's humid. It's been a crazy wet year here, so we're good.
Right. That's actually, honestly, that's one of the only cities that I'm not too familiar with the market in. I know Austin very well. I know Dallas. I'm going to start learning Houston. But tell us a little, how is the San Antonio market right now?
Red hot. I mean, it's blowing and going on all levels, all price points.
And are you guys seeing a lot of investors coming in from out of town, or these are just people that are realizing, hey, there's probably an opportunity here in San Antonio?
Yeah, it's I would say we'll get some waves come in, big corporate companies that'll come in and stir up the market a little bit. But as far as the real players, it's been about the same guys. You'll have a few come in here and there, but it's not just getting flooded.
That's good. That's good. So for those that you guys are listening in who don't know who you guys are, we can start with you, Eric. We'll jump over to Mike. Tell us a little bit more about kind of how you started into this business, or if real estate even wasn't your first start.
Yeah, so I've had a passion for real estate since I was in my late teens, early 20s. I actually went to real estate school in Austin. Cool. I made most of my money in the early years doing pest control. So I had some pest control companies. I was a bug killer. So
which company was it?
Well, I had one was called All American Pest Control, and then I had another one called Black Widow Pest and Lawn.
Okay.
Yeah, those are mine. Yeah.
Cool.
So I did that, to make money so that I could then do some rental properties on the side. I didn't have any cash, so I would do a lot of, creative financing. My first property was a 5-plex. I bought it, assumed the note, and then they did a carryback for the second.
Okay.
So that was my first taste of, rental properties, all Section 8, and that's kind of where I got my start. Went from there, met Mike about 6 years ago, and, we created Alamo Home Source.
So, wow, you jump right into it, actually. Pest control, but then the type of deal that you did is not what most, beginner investors would do. So kudos to you on that one, man.
Yeah, right. In my situation, Frank, I had a successful insurance agency in San Antonio, and I had sold that back in 2004. Ended up with a little pot of money, and I was, I never really liked the insurance business, but decided that, I always had an interest in real estate, so kind of tiptoed in, did the traditional realtor route, kind of became a RE/MAX realtor, and then I quickly found myself gravitating toward the investment side, flipping houses, that sort of thing. And then, like Eric said, when we both connected, he had worked for a company that had actually done a lot of seller financing, and so we kind of started flipping houses, and then we kind of tiptoed in, did a couple of seller financing deals, and we both looked at each other and said, "This blows away flipping, it blows away rentals. Let's rock and roll." And we haven't looked back since.
Exactly.
Absolutely. That's awesome, man, because it's interesting. The reason I like asking that question is, we have a lot of beginner listeners coming in. They're wanting to get started in real estate, but don't know where to begin. And just so you guys know, you guys are probably the 5th or 6th people I've interviewed, and no one's ever just started in real estate. They had some kind of 8-to-5 job and quickly realized, man, there's a better way to make money in real estate. So, you guys mentioned seller financing. Tell me a little about what is it about seller financing that you guys like so much?
Well, obviously the returns are great. You don't have to deal with tenants and toilets and all that kind of headache. but you're getting the above market returns. We really understand it.
Right.
It makes sense to us. We're helping out families in the neighborhood. That's a good thing. It's a feel good business. People that can't get a loan, we're able to, or can't, wouldn't be able to realize home ownership. We're
right.
helping them realize that. Or their only other
so let's do a little bit of let's do a definition so we can help people out to better understand what seller financing is. If you could give it like in a short, 4-sentence kind of thing, what is seller financing?
I'll take that. I mean, basically, you become the bank. I mean, that's the simplest way to look at it, is you become the bank. I mean, and what you learn, or what we've learned, is if you truly model exactly what the banks do when we're talking about escrowing and getting a good down payment and prepaid insurance per year and all the things exactly like a bank does. Now, we didn't start out doing that, but we've learned quickly the banks have got a lot of things figured out. So basically, you become the bank in a nutshell. So
does this mean
property? So go ahead.
Yeah. So, like, with that being said, are you guys, is there underwriting involved? Is there, a lot of the other type of stuff that banks have to do that you guys have to do, or do you guys kind of remove all that red tape?
Being individual private investors, ultimately we make the decisions. Now, there is a licensing aspect to this if you do it in any sort of big way like we do, and that's really not a hurdle that I would have any investors or new investors be concerned about. It's really a relatively easy, inexpensive process. But the bottom line is that you can do your own underwriting. Basically, I mean, it's not a credit score is a good one, Frank. Because I mean, people think, well, they have to have a certain credit score. I mean, at the end of the day,
right?
I mean, you have to basically document that the people have the money to pay and the ability to repay the loan. But other than that, we keep it simple. Keeping it simple for the new investors out there. I mean, the biggest thing is getting a good down payment. And what's a good down payment? We kind of learned that 10% down is kind of the magic number. Most of our homes that we buy in 95 range, and we kind of use 10%, maybe 10 grand down as the magic number. So that's the mistake I think we made early on is not getting enough down. But the bottom line is, if you get a good down payment, that solves a lot of the underwriting issues. Gets rid of the renter's mentality. If someone can come in with 10% down, that's pretty significant. But other than that,
go ahead. I'm sorry, I didn't mean to cut you off. Go ahead.
Other than that, it's just good old-fashioned common sense. That's what I like about it. I mean, we found the people that are buying our homes, they have family ties to the neighborhood. They want to be in these homes, and it's just good old-fashioned common sense. And when you give someone an opportunity to finance a home, or to buy a home, and they may have been living in an apartment for the last couple of years with 2 kids, and they may have gotten rejected from a traditional bank. And there's a lot of reasons, Frank, why someone might not fit into the traditional mortgage box. It could be a credit score, it could be not enough credit, it could be a medical situation that kind of derailed them. So there's a number of reasons, but we kind of fulfill that niche of finding people with money that really want the houses, that really deserve an opportunity. So it's a little bit of cherry picking on the buyer side, when you offer that financing.
So I know Eric mentioned earlier his first deal was a 5-plex. You guys are talking about homes, So seller financing, are you guys focusing mainly on like single family homes, multifamily, and if it's multifamily, what's the largest you guys are like willing to go?
Yeah, mainly all owner single family.
Okay.
Never done a multifamily owner finance. Not saying that you can't do it, but we, like what Mike just said, we stay with the single family because of those reasons. Multifamily, you're not getting a homeowner living there. You're going to have an investor with a bunch of renters. So we tend to stay with the single family.
Yeah. And you touch upon a good point there, right? So seller financing, you guys are looking for a buyer, not a renter, and it's a huge difference, especially when you said you were dealing with Section 8. So the biggest difference is there. Now let me ask you this: are you guys? We always have there's 2 sides of a seller finance transaction, right? You have the person who's trying to get into the deal using your financing, and then you're the other side who is providing the financing, right? So do you need the cash as a financier to do this, or is another option to get around that? Like, do you have to have your own cash to finance the deals, or are you using someone else's?
Yeah, I think one of the things for all the listeners, Frank, is a lot of people, I think, have a mental block to doing seller financing because they think it's very cash intensive and they may not see themselves capital intensive. They may not see themselves as being able to do that. But what we've learned, we didn't start out with much cash at all, and so you have to have some sort of cash. What we like private lenders, and we started with private lenders, and then kind of evolved more to banks and that sort of thing as you get more established. But private lenders, there's people out there a lot of people out there, especially in the market these days. Banks are paying nothing, stock market's up and down, and there's a lot of private money people that are just afraid of the stock market. And when you prove to them you're an expert, Frank, I think that's something I wanted to piggyback on from a minute ago that we said.
Please.
Was for all of the listeners, I think whether it be seller financing or traditional flipping or rentals or whatever, I think our model's the best. It's been our experience. But I think the idea is to become an expert at one thing. And that's why, back to Eric's comment about, multifamily, yeah, early on we tiptoed into this, we tiptoed into that, we tiptoed into that. And if you look up now and, we've learned the hard way, we're better off just to do this and be laser focused on one thing. And that's been the key to our success. So I think for all new people, real estate investing is a broad brush stroke. And I think for us, even though we get tempted with other deals every day of the week, we stay the course, and that's what's made it. Look, go back to your question. That's what made it work for us. Back to your question about cash. We really think that you start out, with scrape up as much cash as you can. Even when you go to a private lender, you say, listen, I've got 10 grand. I need 50 more, or I've got 20 grand. I need whatever the numbers are in your area. I mean, luckily San Antonio's one of the more affordable priced markets. A lot of the homes we're buying are in the $50,000, $60,000 range. But when we started, what we did is we went to our private investor and said, listen, you put up the money for the house, and we'll go ahead and pay all the money on the renovations. And we paid them a reasonable return. But that was like, hey, we're not just saying, give me some money. We're partnering with you. We went into this thing. Hey, our skin's in the game. We have skin in the game too. So that's the advice, I think. You do have to get going. But then, one thing, Eric, what we discovered, once we get that first note, so let's just say, you have a private lender that gives you $50,000 and you were in the rehab for $10,000 or $15,000. So you only got $10,000 or $15,000 of your own cash in there. Well, then, you just like you can go to get a loan on a rental, you can take that real estate note. Okay, once you sell that home to a borrower, now you've created the real estate note. You can take that real estate note to a bank and then end up getting your cash back. Okay, sometimes they'll lend you somewhere around 80 cents on the dollar. Has kind of been our experience. Now I must admit, it's not as easy as maybe the typical bank that does a lot of rental properties, but it really hasn't been hard for us. There's plenty of banks. It's just some of them, some I guess are a little more difficult.
I think your big corporate banks probably aren't going to.
Yeah, more local banks probably. Yeah. But anyway.
Yeah. So then you kind of briefly tapped on what you guys are doing. So, to our audience to have a better idea of kind of how your business model works, you guys are purchasing performing notes, non-performing notes. Is that how it's going? And then you guys are, tell us a little about how you guys are doing this.
No, we actually create the notes.
Okay. So can you elaborate a little bit on that, Eric?
Yeah. So we buy a house, just like if you were going to flip it or rent it, we rehab it. And then instead of flipping or renting, we actually sell or finance it. So we put the house up like we're the bank. So we owner finance that house, create a note, and then we sell that note to private lenders, or we will go out and, like Mike said, we'll pledge it as collateral and get our cash back and go do it again. The ultimate goal is to not ever have to sell a note, but for now we're obviously having to sell them because we have overhead, and we have a pretty large operation here. So we hold as many as we can, with our long-term goal being to hold every single note.
Do you guys have a number in mind of how many notes you guys want in your portfolio?
Every year it goes up. Right now it's at about 200 is what we would like to be at each.
Yeah.
These are cash flowing notes, correct?
Cash flowing notes.
Oh, wow. I wonder how many people on the call who are listening was like, I wish I had about 10 of those.
Well, the thing that I wanted to elaborate on again and again for new people, because I fell into the trap of just thinking, I'll never have that kind of money. I'll never raise that money. It would take me 5 lifetimes to get the kind of money I need. And like I said, back to our example, if you get one real estate note done, then like I said, you could sell that note, realize a profit. Now you have more cash. Well, and then you can do it before you know what you're doing too. Before you do it, yes, exactly. The compound effect. that's what I just want to encourage new people to do. I mean, like I said, when we first started, we both had a lot of rental properties. That was kind of the tried and true. And let's face it, rental properties have been a successful model. But this is just superior, in our opinion, for a number of reasons.
It's interesting. I think that there's two groups out there. We have people, we have a family business. We do rental properties all the time. We have done Section 8. Actually, we have a lot of tenants who are still Section 8. It's just predominantly what we like to work with out in Dallas. We asked, one of my business partners, she's a landlord. She's been a landlord now for about 20 years. Like, how about seller financing? There's some deals here in Austin. What are your thoughts on that? She's like, oh, it's just a headache. I don't know if I want to deal with that. What if they default? All these other things. And then here you guys are being like, yes, yes, yes. So what is your thought process with these two groups right now? Like, obviously you guys are on this side. My partner's on this side. Where would you tell the investors who are listening right now which is the best side?
Well, obviously the owner finance is the best side. It's just different perspectives. I mean, she's looking at the default and that scares her. I look at tenants and vacancy rates, and that scares me. So I guess it just depends, on which side of the fence you're on. I would say from a consistency standpoint, owner financing is probably better. It's more long-term. You're not going to have a lot of the high turnover rates. Out of we're servicing probably 400 notes.
Yeah, like that.
And we have less than a 5% default rate.
Oh wow! I should bring that back to her. That's good.
It's not like if we had 400 renters, I mean we'd have probably 20%, 30% tenant vacancy and eviction rate. I'm not sure what it would be, but it's not that bad. If you do the underwriting the right way, you won't have a lot of problems. If you're taking the first person to fog a mirror that has a couple $1,000s in their pocket, you're basically going to build a glorified rental program, and you're going to have the same headaches you're having with renters. But if you're diligent, you underwrite, you do it right, you get the money down, you shouldn't have any problems.
So to be clear, you guys are not landlording these properties, correct?
Not at all.
Okay. I would expect Eric to be happy about it. Be like, absolutely not. So, you know what I mean? So,
I want to add something. I want to add one thing.
Yeah, please.
You mentioned the Austin market, which you're familiar with. I don't think our model with the returns that we're producing, which are 15, 18% returns by the time you factor in our base interest rate plus the profit built into the deal, I don't think you can pull that off in a red hot market like Austin. And not to contradict what we said, San Antonio is a hot market too, but there's you can still buy homes for 50, 60 grand down here. And that is one thing. So when you're talking, it may not be apples to apples. I mean, in general, some markets are probably tougher to get the kind of returns we're generating because just the price point's higher, and that does affect the returns because yeah.
No, Mike, you said it perfectly, and you're exactly right, which is our market, which was maybe 5 years ago, this could have been a potential option. Like Dallas and Antonio, you're still able to find properties that are $50,000, $60,000, $70,000 with enough, potential upswing to make a good cash flow, or if you decide to flip it, you have money there. At Austin now, we're at the primo of the market. People are overpaying. You're literally not making any money if you're going to be, seller financing this property.
Right.
So if you're listening to this, if you're in California, you're dealing with $500,000 homes, your upper Midwest, wherever you are, you got to be, you first got to find out the nice niches where you can actually find properties for this much.
Yeah, and I think, Frank, really you probably picked, what do you think, 125,000 or less, somewhere in there, everything still works. I mean, I'm talking to get the kind of returns we're used to generate.
Oh, absolutely, yeah.
I mean, it's not like you couldn't seller finance, and I could even argue that, you got the $250,000 home. I could still argue that it might make sense to owner finance that versus renting it too.
It depends on what kind of return you're wanting. I mean, if you're happy with an 8 to 9% return, which I think most people would be, then you can owner finance anywhere.
We're spoiled. I mean,
I think we're a little spoiled, and I think even in the big cities, you're still going to find pockets, where you have the price houses in. And it's all relative to the area you're in.
Yeah,
absolutely. So let me ask you guys this: a quick question. Go ahead. I
don't want to, put the nail in the coffin on Austin markets and California markets, because there's people I know in Austin and California that owner finance. I mean, there's, seminars all over the place, people, doing and teaching owner financing for those markets. So you can owner finance anywhere. You just may not get the 15 to 18, 20% returns like we can get here in some of these South Texas markets.
No, Eric, I appreciate you clarifying that. And that's true. Yeah, I'm just saying, if you're investing downtown area and surrounding in Austin, within a 5-mile radius, good luck. Kudos to you. Even on the east side, good job. But if you're anywhere north, of course, where I live, even in Round Rock, Pflugerville, not really outside Austin proper, you still have this opportunity. Absolutely, absolutely. So let me ask you guys this. In your opinion then, what do you feel like, what type of person, best type of lead to seller finance deals to?
Yeah, well, for our, like we touched on earlier, I mean, from an underwriting perspective, the way we describe it, these sub 100 price point in our market, I'll just use what I'm familiar with, what we do, is what we've learned about these neighborhoods, where you might drive through these neighborhoods, Frank, and say, I never want to live here. What we've learned is the people that buy these homes have family ties to these neighborhoods. They want to be there. They went to school there. There's a very tight
community
there. So I would say, from our perspective, since we've sold hundreds and hundreds of homes, I mean, our referrals, we're getting referrals all the time. So we love the referrals. Now, nice. Just getting started, I mean, I think it's basically, good old-fashioned marketing. We call them bandit signs, good old-fashioned signs. We're licensed real estate brokers. When we put our properties, yes, sir. When we put the MLS, I mean, all we found ourselves doing is trying to educate a bunch of realtors on how this seller financing thing works. We quit putting stuff in the MLS and just started putting old-fashioned handwritten signs on, and our phones lit up, blow up, and that's the advice to the new guys out there. You really don't need, to follow the traditional realtor route on that deal. You can go ahead and just put your signs up. So, you're talking about
I think we lost you guys. Hold on. And I think are you guys back?
We're back, right?
Okay, cool. You gotta love technology, man. And when internet cuts out, it's like we just run around with our chickens with their heads cut off. We have oh no, it's over. 2K or what is it? I forgot what that was. Yeah, Y2K. There we go. It's oh no. All right. So what were we talking about? We were talking about the best leads to work with.
We were talking about the leads. You were talking about the leads, a type of lead, right? And and basically what we've learned, Frank, like we said, is the people that want to be in these neighborhoods. They usually have family ties to the neighborhood, and they're the type of lead. The message to the new investors is put a sign in the yard and a few signs. You're going to get your phone light up. You're going to find people that really want to be in that house, family ties to the neighborhood, and and for whatever reason they've been rejected by a bank. They have they just for whatever reason can't fit in the traditional mortgage box. So they'll find you, I guess, is the message. Okay. I mean, and the great thing about the seller financing, when you offer seller financing, the demand, Frank, is so high. I mean, there's so many people out there that want that financing opportunity. You literally can sit back and say, no, kind of like looking through 20 resumes. I mean, they will find you. All you got to do is some basic grassroots marketing, and they will find you.
I gotta, you're on point, Mike, because it's true. We do guerrilla marketing, we do bandit signs, and ideally for seller finance, even when people are calling, they'll ask you, right? Hey, do you guys do seller financing? So it really comes down to your personal marketing. People are like, you spend thousands, hundreds. If you just have some sweat equity and, get your butt out of your chair and staple some signs to a pole, you'll get people calling you, especially if you're just to get attention, zero down, depending on your credit. Of course, their credits are never going to be good enough to where you can at least get them on the phone. That's the whole purpose. Yeah. So fantastic. So with that being said, are you guys using any type of specific type of paperwork, something that you guys hired an attorney to draft up for y'all, something you guys are just writing on a piece of paper and having people sign? How do you guys get people to commit to something like this?
Let me take that one.
Yeah.
I mean, the reality is, in full disclosure to all your listeners, there is a fair amount of paperwork associated with the seller financing model. But the way I look at it and the way we've kind of embraced it with all the Dodd-Frank rules that affect the mortgage industry and that sort of thing And that's the thing, Frank. People have to end up wearing two hats if they're going to do the seller financing model. They're the real estate side, the real estate investing side, but they also have to kind of tiptoe into the mortgage side and learn a little bit of the ropes there. But the bottom line is, the advice is yes, use standard real estate contracts that are promulgated from whatever state you're in, and obviously realtors have access to that. Use a reputable real estate attorney to prepare the legal documents, because if you ever get in a situation where you need to have a foreclosure or something like that, you know that all your I's were dotted and T's were crossed. And then, from the loan side, there's loan disclosures and that. So there's a few more hoops to jump through, but I don't want that to intimidate your listeners, because I'll tell you, once you dive in there, it's kind of like the higher up the ladder you go, the more people fall off. And that's the thing. Not everybody, a lot of people are intimidated by the seller financing model, and rightfully so. There's a little bit more of a learning curve there. But what we've learned, we've just embraced it, Frank, and it's really like anything else. Once you do it a few times, you got it. It's the same form, same documents over and over again. And the last caveat, which I'm sure is good advice from everyone's perspective, making darn sure you do close at title companies. I mean, there's no Mickey Mouse transactions. I want to be able to wrap up a file, put it in the file cabinet, and know I've got a rock solid deal, title insurance for the buyer. I mean, clean, 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 clean. That's the name of the game.
I would add
Absolutely.
That make sure, whichever attorney you're using does have some sort of knowledge of the Dodd-Frank laws, as those will apply to you whenever you're seller financing to a homeowner.
Absolutely.
And I'm glad you got it. I have a YouTube video on Dodd-Frank, guys. If you have any questions on Dodd-Frank, check out our YouTube channel. It's a brief kind of synopsis of what that law was and kind of how it affects the lenders and it affects the investors. So definitely check that out. And I think they passed that, it was, 3, 4, how many years ago? Do you guys remember? It was a couple years back.
Well, at least 3 years.
And they've made some modifications to it as well since then, correct? Right.
They continue.
Okay. Yeah, absolutely. I remember there was a webinar I listened to a few years back where the guy was like, any city, any major city you're in, you look downtown, what companies or what corporations have the biggest buildings?
Yeah.
And usually the banks, it's usually the banks. And it's because, they're buying paper. They're not in the business. I always say they're not in the business of wanting to own homes. They're actually trying to release them to investors, and they want to make the cash flow on these notes. So this is exactly what you guys are doing, kind of on a much smaller scale. But even on this small scale, it's such a great opportunity for us. You guys have 200 each, which I'm sure is cash flowing amazing right now.
No, that's our goal.
That's our goal. We don't
200 each. I thought you guys already did. I was like, you guys want to go more than that.
If we had 200, Frank, I'd be on the beach right now, not talking to you.
And that's going to actually lead us to our next question, which is, on average, how long are you guys wanting to hold on to these properties or these notes for?
How long do we hold? How long do we want to hold on to?
So that's two questions. How long do you guys, on average, hold these? And ideally, do I have to hold them for only 5 or 10 years, or can I hold them for 20, 30, 40 years?
Frank, it depends on what your exit strategy is. I mean, if you're looking for passive income, hold them forever. If you're looking for, capital gains, then obviously you're going to want to hold them for as short as you can, sell the note, realize your profit, and go do it again. But by doing that, you're going to create a job for yourself forever. So we do a little mixture of both. So we'll sell some notes, obviously, to realize the profit, and then that pays the bills. And then we hold as many as we can without, going broke for the passive long-term income to get to our 200 goal.
Right.
So it just depends on, what you're wanting to do.
Let me ask you this. There's something that just came across my mind is, of course, 08, 09, it happened. What would you guys, if you did hold on to 200 notes, would have 08, 09 affected you guys negatively, or how, does that help you, or do you kind of ebb and flow with how the market goes?
Can I take that one? I think that's a great, great question. And every one of our private note buyers asks a similar thing. What happens, when I'm buying this, or what happens to notes? The beautiful thing about our model is that I really think the segment of the population that we're selling these notes, selling these homes to, I should say, really are going to be not that affected by a major stock market crash or, God forbid, another 9/11 incident, that sort of thing. These are just basic affordable housing, and that's why one of the things that when we do try to give advice to new investors, we try to get everyone to kind of focus on those lower price points. That's where your returns tend to be higher. And I think that segment of the market is going to be less affected in that case. So that the reality is we don't really give that much concern whatsoever. I mean, the reality is we just don't think that segment of the market. And think about this, Frank. So let's say you had a rash of foreclosures or something. I mean, just take a worst case scenario you can dream up. I mean, then you turn around. I mean, you remember the process is you would end up getting the house back, right? Because the house is the collateral for the note.
Right.
So then you can turn around and rent the house. So, I mean, that's what's beautiful about this investment model in general. You've got multiple options, really. So that's one of the reasons we went into it is because of that.
Exactly. As long as you're as long as you're buying and creating those with the right houses, if you're sitting on a portfolio of $500,000 houses in 2008 hits, I'd be a little nervous because those are the guys that are going to get affected, and then you can't just rent that kind of house out, So with the basic affordable housing, it'd be fine.
Yeah.
And maybe you guys could piggyback on this. I always remember us try to encourage people to sell our finances based on these principles, which is you get paid in three big ways, right? When they put a down payment down, which in most cases is non-refundable, right? And then you have your second one, which is cash flow, when they're paying you monthly on their note. And of course, the third, when you guys decide to sell, you guys have the capital gains, correct? So that's kind of how we try to, if you guys are in the short game, in 5, 10 years, these are kind of your three profit centers. What are your thoughts on that? Is the upfront down payment that big of a deal, or how do you guys see it? Do you guys see it that way?
I see it's a big deal for underwriting, but as far as for profiting, because of the way we have our model set up, where we're selling them right out the gate if we are going to sell them, and then we're holding them long term if we are going to hold them. But that short 5 to 10 year, I guess it would kind of come into play if that's your strategy. I mean, at least you're going to get some of your capital back.
I think you're on target. I think, like I said, from an underwriting standpoint, knowing you get a big down payment, yes, you put a little money in your pocket too, but it's more the fact if you're thinking long term, you got a big down payment. That's the big start, and you know that you just drastically increase the odds of your stream of income for the next 30 years being nice and steady and smooth, because you got that big down payment.
And I want to bring that. And that's exactly what I asked you guys. I want to bring that focus in, which is, there's a lot of people out there. There's a lot of gurus out there saying, this is seller finance. You get paid up front, you get monthly, you get the end. But I want you guys to really remove all that, noise and really think, if you guys are in the cash flow game, this is how you got to position yourself, with notes or with rental properties. If you don't want to be a landlord, then definitely consider this as a potential option, guys. I would say a ton of landlords that I know who are seller financing, like I just said, they were landlords before. There's good reason why they switched out of it. I was too. And I've always considered that as an option. I live in Austin now, and hopefully Houston has some pockets I can apply the strategy to. Now, with that being said, what type of returns? Let's get to the fun part of seller financing. What type of returns are you guys looking for? Is there a set range to be worth your while?
I would say, if we're going to be holding them, we're looking in the 15 to 18%, depending on how good we can buy it. And if we leverage, we're going to be trying to get about a 7% spread. So that makes sense?
Can you elaborate a little bit more on that 7% spread?
So, if you're, let's say the note, you're into it for 15%, and you're going to go and use a private lender or go to a bank and borrow against it, you want to have at least about a 7% spread there that you're making interest on.
Right. So whatever they take, you still have 7.5% left,
Yeah.
correct? Right. Okay. And as a beginner, is that feasible? Or
Yeah.
okay.
Really
I don't want people thinking like 15, 18%. Man, what are my funds doing?
Now the note is not created at 15%, obviously. So if you create a note at 10%, but you're only, let's say you sold the house for 100, you're into it for 70, and you created a note at 100 at 10%, your actual return is not 10% because it's 10% of 100, but you're actually into it for 70. So you'd go into a financial calculator, back into it, and find your true return. And so that's when I say 15 to 18%. Obviously, you can't charge that much money. It's in the car business, So.
Oh, you just gave one of the trade secrets away. You're gonna have some car guys knocking on your door now.
Yeah.
So I'm curious, guys. You've been doing this for how many years now?
6 or 7.
Yeah, together 6 or 7.
This model 6 or 7.
I've been investing for over 15 years.
Yeah.
Obviously, you guys, you've learned, the tricks of the trade. You've also learned a lot of the mistakes you've made. If you had a chance to go back in time, jump in your time machine and talk to your younger self before you got started, what would you warn them of the mistakes that you made and how to avoid those? I love this question.
All right. I just think, there's no shortcuts to success. It's a lot of good old-fashioned hard work, and I think in taking a long-term approach, I think that's the biggest mistake so many new investors take. And that's one thing, having a partner, having an accountability partner and a business partner where, when he's up, I'm down. When I'm down, he's up. So you kind of keeping each other focused. Hey, there's going to be issues. There's going to be headaches. But at the end of the day, real estate investing, in particular, I think the model we do, is going to pay you big long term. It's just one of those slow and steady is the way to build wealth. So I think just preaching to the younger crowd out there is, it's a great business. It provides everything you want, the flexibility, the income, the big payday, the unbelievable, amazing retirement. So just stay the course. It's the guys that just stay the course. You don't have to be the smartest. You don't have to start with the most money. It's just the guys that stay the course are the ones that win. So that would be my advice.
I couldn't have said it better. Stay the course. I've done so many things, in my early 20s that if I would have just focused and stayed the course, I'd be a lot further along than I am now.
Isn't it funny how, we hear these things when we're younger from the older people, but I don't know what it is. Call it being stubborn. 5, 10, 20 years, we find ourselves saying the exact same thing, giving the younger people the same exact advice. It's a vicious cycle, but, there's so much truth behind what you guys are saying. And for our listeners, I think one of the things we always told about is, there's so much great information out there, information you don't have to pay for. And the only thing that's holding you back is taking action. I know you guys hate hearing that. I personally hate hearing it as well. But that's really the only way to see true results is to stay the course, like Mike and Eric said, and to really, even I was listening to Elon Musk the other day, with that huge, explosion. He had to stay in the course. This whole SpaceX thing, he had so many people saying, don't do it. You're going to blow all of your fortune on this. But he's staying the course. And my gut tells me it's going to be amazing what's going to be produced from this. So, for you guys out there, I want you guys to really take the seller financing to heart. If my landlord's out there, maybe you're at 5, 10 properties, you're tired to start dealing with your tenants, consider this as an option. You're getting into this deal. You're a newer investor. You don't have a lot of money in your hands. Definitely do this type of investing. You get to learn about the financing side, which I think every investor should know about, and how cash flow works. And of course, dealing with different types of tenants that don't always deal with banks. And I think this is just a phenomenal strategy, guys, that you were doing, and I really appreciate you guys kind of explaining it on more detail. But, we are limited on time, and I would love for our audience to be able to reach out to you guys. If there's an opportunity, if you guys want to leave comments below, if you're listening to YouTube, feel free to do that. These guys will be there answering questions, leaving you guys links to get access to stuff. But, how do our members get a hold of, you guys? What's the website that you guys have? All right, I think we just lost you via video, but you guys are hearing audio, that's fine. All right, I guess we're just having a lot of technical difficulties with this call. It's okay. We're actually towards the end now. I just wanted to give you guys an opportunity, in case our members have any further questions or would like some continuing education, learn more about seller financing. Do you guys have a website that I can give out so they can check out?
Yeah, definitely. We have thenotesfactory.com. That's thenotesfactory.com. It's got a lot of great resources on there. We have the videos. We have one little mini free education course, just a wealth of information on there for your caller. And if they any other information, they can reach me at Eric, ERIK, at Alamo, ALAMOHS.com. So Eric at AlamoHS.com.
All right, awesome, guys. And I'm guessing if they have any questions for Mike, they can get a hold of you there, hold of Mike there as well.
Exactly.
Awesome. Well, thank you guys so much. We're coming down to the hour. I really hope you guys enjoyed today's content. I want to personally thank Mike and Eric so much. You guys are fellow Texans. I appreciate the time you guys are taking out to really share y'all's wealth of knowledge. And we look forward to talking to you guys next time. Again, this is French with REIClub.com. Do us a favor, if you haven't already, leave us some comments. Eric and Mike will be on this page here and there answering y'all's questions. If you have anything more detailed, partnering, things like that, let us know in the comment section below. If you're listening through iTunes, we would greatly appreciate it if you left us a favorable review on there. It always does help us out. And of course, you being here every time listening to us is what we do this for. We appreciate you guys and all your support. So with that being said, we're going to conclude today's call. We look forward to talking to you guys next time. Take care, good investing, and bye-bye.
Thanks, Frank. Thanks, Frank.
Today, I got a quick video for you covering the 5 important landlording tips that are going to save you hundreds, if not thousands of dollars every year. Is there a time frame of which I have to keep that money in before I can pull it out?
That really varies upon which platform or which fund or investment vehicles you invest in. Some